Hello again, and welcome back to Financial Markets Language with Blake. I am Blake, and we're going to be going over what happened. Today was a busy day. CPI came out at 8:30 Eastern. Definitely was a little bit hotter than predicted, but not bad in the grand scheme of things. The month over month came out at 0.5 as compared to the 0.4 estimate. The year over year came in at 6.4, much higher than the 6.2 estimate that was predicted. And the core CPI came in at 0.3 as opposed to the 0.2 estimate. So both month over months just beating by 0.1. Annualized, the normal CPI, including food and energy, came in at annualized, 0.4 times 12. You're looking at 4.8%. So in the grand scheme of things, still not that high. 0.4 is the estimate, my apologies. So you're looking at 6%, which is approximately what we have on the year-on-year, meaning that inflation is a lot stickier than a lot of people were predicting, myself included. I was definitely on the side that we were going to get more of a drop down. But in my defense, I feel like the biggest argument that was defeating the CPI was mainly the fact that it was recalculated as the start of the new year began, with owner equivalents rents making up 25% of the total, much more than previous. And now that's owner's equivalent rent, it's all subject to what homeowners think the rent should be, not what actual fair market price is right now going. So definitely a different ballpark that a lot of people are playing. As far as earnings, in the morning we got Coca-Cola with a slight beat, and it ended up going down in the day. A large part of this is just due to the fact that staples, consumer staples such as Smucker's, Coke, Pepsi, Marriott, other hotels, just general low PE cash flow, well-known consumer businesses were definitely well invested in 2021 and 2022 when people are trying to diversify, still stay in the market, but get out of more risk-on assets. So even though it did beat, people need a lot more to keep the current price to earnings ratio, which is way higher than historically it has been. After hours today, we got Airbnb reporting. That was the biggest one that I had my eyes on today, and at least for them, they report a slight beat in the current quarter, but what mainly shot the stock up in the after hours was the guidance, the fact that they're able to continue pushing prices up and they're able to maintain margins despite a general slowdown in the economy. Definitely makes Airbnb considerably more appealing, given that it's typically grouped among a lot of the risk-on stocks and is consistently quarter over quarter seem to perform. Definitely continuing to keep my eyes on this one, but currently not looking to add any additional into just about any company at this point. I wouldn't say I'm overly bearish, but definitely a lot more indecisiveness in the market that I just wanted to get settled out. I do realize that by waiting for this indecisiveness to go out, if it does just go out right now, the market will trend higher, and if I were to buy in later, it will almost certainly be at a higher price. But paying an extra 10 to 20%, 20% most for a company like that would definitely I think mitigate a lot of risk, as opposed to investing now at 10 to 20% lower, but you're in a much different economic environment, which definitely has its pros and cons, which is why people jumped in obviously right now. There's definitely a great argument for that. Big data that we got coming out tomorrow. We have retail sales coming out tomorrow, 8:30 Eastern, and then we also have the Empire State Manufacturing Index coming out at 9:15 right before the market open, and then we also have the industrial productivity rate. The big one that I'm looking at is mainly just the retail sales, as I imagine most people are mainly focused on this data element, because as retail sales, we need a consistency or a slight decline. If retail sales start to spike all out of nowhere, you could easily see a double dip recession, Fed go back into hiking mode, and also, not to mention, they definitely got a little bit more ammo in their arsenal with this last CPI, with many things still wildly going up month. Obviously, the month over month was still just 0.5, But in the subcategories, there are many categories that are still spiraling out of control, like pet care, clothing. Yeah, definitely. Well, a lot of it could be attributed to the type of clientele that would be purchasing these items still are in the upper class and the upper middle class, and because of that, they still are not on edge when it comes to the amount of money that they have on discretionary goods. But in most other areas, you're definitely seeing a pretty stabilization, which is still means that the rate, because the CPI is the rate of inflation, is still relatively high. But we really need demand to just kick down another notch or two, or supply to rapidly keep coming up, because many items are still just very sticky with inflation, at least according to this last month's CPI. If you look at the chart today, you definitely see a wild spike right at the CPI, and then a choppy open with just in the first 2 hours, a big dip, a big spike, another big dip, and then throughout the rest of the day seemed to just slowly climb. So definitely not as eventful as a lot of people were hoping, but also the CPI was definitely a lot less eventful than a lot of people were hoping. A lot of people were hoping for just more of a surprise, either on the upside or downside, and that obviously was not delivered. It was definitely on the high side, but not by a much. It didn't give the Bears a lot of argument, didn't give the Bulls, definitely didn't give the Bulls any more argument. Just shows CPI is still a little sticky, gonna need some more time. As far as commodities, we definitely had a pretty stable day today. The dollar didn't really move much, oil didn't move much, gasoline RBOB didn't move much. Yeah, definitely silver, gold, definitely was a pretty stable day. Not really too much ammo added to either side. Definitely a little bit more of the Bears, but not by much. So very uneventful in general. Treasuries definitely did spike on the CPI. Big, both all across the board. 10-year, 2-year, 6-month, 30-year, everything went up right when the CPI came out. And in general, they continued to trend down the rest of the day as the buyers came in. One big thing that started to tank was used cars and trucks. Definitely a big fallout in the CPI. The prediction was for it to go up 2%, on the month, which annualized would be 24%, a massive increase. But instead we got a negative 1.9%, which was practically the exact, same amount in the opposite direction, just, need an extra 0.1. Huge jump. Definitely no one saw that one coming.